You know, over $100 billion in gold changes hands every single day. And if you trade XAUUSD, you already know it can feel like an absolute battlefield. But what if I told you the chaos you're seeing is actually highly orchestrated? Welcome to The Explainer. Today, we're doing a high-level, institutional price action breakdown of gold CFD trading.
This right here is the hard truth we absolutely have to start with. Most XAUUSD traders don't lose because gold is difficult or unpredictable. No, they lose because they keep selling obvious highs and buying obvious lows. It's really that simple. They are predictably donating their money by completely misreading market structure and walking straight into traps.
So the whole objective of this explainer is to shift you from an emotional mindset to an institutional one. We're going to deconstruct the 6 core XAUUSD trap map setups. Now, our goal here isn't to magically predict the market. Nobody can do that. Our goal is to recognize these traps before you become liquidity for the market makers. All right, let's dive right in.
Section 1. Clear high and low hunts. Let's look at traps number 1 and 2. Okay, trap number 1, the clear high hunt. In practical terms, you'll often see this exact setup playing out during the London session. Keep your eyes peeled for an obvious high that gets broken by just a small, weak candle. Then, literally almost immediately, it's followed by a massive, strong, bearish engulfing candle. That right there, that's the visual signature of the trap. Now, the psychology behind this move is brilliant, but honestly, it's ruthless. The retail trader looks at that old high and immediately thinks, oh, time to sell, and they smack their stop loss just above it. But the market maker, they know exactly where that giant pool of liquidity is sitting, so they push the price up just enough to trigger those stops, grab the liquidity, and then aggressively drop the price in the original direction.
So how do we actually trade this using pure price action? It's all about patience. Step 1. Do not sell at the obvious high. Instead, wait for that high to be swept. Just let the market maker do their dirty work. Then, wait for the price to come back to retest that level and show a clear rejection. When you finally enter your short, your stop loss absolutely must be placed safely outside that hunted liquidity pool, right above the sweep.
Moving on to trap number 2, the clear low hunt. Now, this is the exact mirror image of the first trap. You really have to be careful when you spot this on an M15 or H1 chart. What you're looking for is a long, deceptive wick piercing down through an obvious low. You'll probably see a sudden spike in volume right at the absolute bottom, followed by a really strong pin bar or rejection candle.
Behind the scenes, here's what's going down. The retail crowd is blindly buying that old bottom, stuffing their stops right underneath. The institutional players just sweep down, trigger those sell stops to fill their own massive buy orders, and then forcefully reverse the market. The application here? Absolute patience. Never ever buy the old low. Wait for the sweep, wait for the confirming rejection candle to prove the trap is sprung, and only then do you enter the buy safely.
Section 2. Ranges and news fakeouts. Let's look at traps 3 and 4. This brings us to trap number 3, range manipulation. You will see this constantly right before major data drops, like CPI. Gold just creates this tight, choppy range, usually squeezing between $10 to $40. There's no real trend, just a bunch of rejection wicks on both the top and the bottom. Retail traders, they're desperately trying to buy the bottom and sell the top of this tight little box, basically getting chopped up in a blender while the market quietly builds liquidity on both sides.
So what's your plan of attack here? Simple, stay out of the chop. Do not trade inside that tight range. What you want to do is wait for the market maker to break out of the range with actual momentum. You are specifically looking for a true break of structure, a boss, and then you strictly enter on the retest of that broken level. Which brings us to arguably the most violent trap of them all. Trap number 4, the news fakeout. When major red folder news hits, XAUUSD predictably does 3 things. First, it sweeps the high. Second, it sweeps the low. And third, it finally chooses its true direction. I mean, you'll literally see candles with $30 to $100 in a single minute, visiting every recent high and low just to clear out the liquidity.
The emotional trap here is trying to guess the direction of the news. Just don't do it. The golden rule? Absolutely no orders 15 to 30 minutes before a red news release. Let that initial chaotic news candle do its dirty work and sweep both sides. Then, just wait for a new, clear market structure to form post-news, something like a higher low to a higher high, and enter based only on that newly established structure.
Section 3. Breakouts and Imbalanced Greed.
traps 5 and 6.
All right, trap number 5 is the classic fake breakout. You'll see this happen all the time during New York volatility reversals. Price breaks a major supply or demand zone, but look closely. The candle body is totally weak. There's absolutely no follow-through. Instead, you get a strong, immediate reversal candle slamming right back into the zone.
It's classic FOMO. Breakout traders see that line cross, they panic, they jump in, and instantly they become the liquidity for the institutional reversal. To avoid becoming that liquidity yourself, never trade the initial break. You must wait for a true break and a retest, focusing entirely on spotting a clear rejection signal right at that retest point.
Now, before we hit the final trap, we need to quickly wrap our heads around a core concept of market efficiency, the fair value gap, or imbalance. When price moves too aggressively in one direction, it literally leaves a void of unfilled orders behind it. Smart money, the large funds and banks, they want the best prices, so the market naturally has to pull price back to these inefficient zones to fill that liquidity before it can make its true move.
And that leads us directly into trap number 6, imbalance greed. On the chart, this looks like a hyper-aggressive $20 to $40 impulsive move with zero pullback, just a massive gap left wide open. Retail traders see this rocket ship taking off, they completely panic that they're missing out, and they jump in at the absolute top. Meanwhile, the market maker is essentially saying, yeah, sorry, I have to go back down and fill that imbalance first.
Let's look at an incredible real-world gold example from the explainer to see exactly how this plays out. Imagine price is just sitting quietly at 4320 right before non-farm payrolls. The news hits and bam, price spikes in a straight line up to 4360 in just 5 to 10 minutes. That massive spike creates a huge fair value gap between 4328 and 4351. Right around minute 15, 90% of retail traders let FOMO take over. They buy the top around 4355, sticking their stops right below. Over the next 30 to 60 minutes, price inevitably drops back down to 4330. It fills the imbalance, sweeps every single one of those retail stop losses, and only then does the true institutional rally to 4380 actually begin.
So the absolutely crucial point here is how you handle that imbalance greed. Never ever enter after a fast $20 to $40 impulsive move. You have to patiently wait for the price to return and fill that fair value gap. Once it's filled, watch for your price action signal, like a solid pin bar or an engulfing candle, and then enter the trade alongside the institutional flow, not against it.
Section 4. Applying the trap map with pure price action.
Okay, here is your definitive 6-step pure price action playbook for XAUUSD. Step 1. Identify which of the 6 trap types is setting up. 2. Mark the nearest obvious highs and lows. Those are your liquidity pools. 3. Watch patiently for the fake out or the rejection. 4. Enter the market only after the trap is fully complete. 5. Always place your stop loss safely outside the liquidity trap area. And 6. Take your profit at the next logical supply or demand zone.
We're going to leave it there for today. Remember, the gold market does not just randomly destroy traders. It simply exploits those who misread market structure and blindly walk right into traps. The place that looks most obvious on gold is very often where traders just donate their liquidity. So the next time you see a perfect, totally obvious setup on your chart, I want you to ask yourself, are you the hunter or are you the liquidity? If you want more institutional-style gold analysis using smart money concepts, price action, and professional market structure breakdowns, go ahead and subscribe to the channel. Thanks for joining me on this explainer, and trade smart.